But so yeah, so we'll do this for the first half of class, and then this will be the second half of class. And again, if you already turned it in, there's no need to, well, you're welcome to stay, but okay, so today we're going to start in on chapter 3, ethics. And ethics is a really big thing on the CPA exam. About 20% of the CPA exam is ethics. They really beat this up. Okay, independence, covered members. All right, there are, in a CPA firm, there might be hundreds or thousands of different people in a CPA firm. And when it comes to things like independence, the question is, well, who really needs to be independent? So there's kind of like two layers. There's everybody in the firm has a certain base level, right? But then people who can influence the audit, they are held to a much higher standard. So those are called covered members. And the reason they're called covered members is they're covered by the independence rules. So there's, all the CPAs, all the professionals down here, they're held to a base level, and then there's some that are held to a higher level. So we're going to start out with the rules for the higher level of people called covered members. So covered members are anyone that can influence the audit. Okay, I think I mentioned this last time that these different levels are those that are designated by the AICPA. So the AICPA says that, these are the levels of people in your firm. Even if you don't use these terms, you have to put people in one of these levels: partner, manager, senior, or associate. So it's called assistant auditor. They can be called other things, but okay. So who must be independent? Anyone who's on the audit engagement team must be independent. So in other words, if you're doing the audit, you must be independent. Doesn't matter what level you're at. You must be independent. So anyone who's actually on the audit, you call it the audit engagement team. Anyone who's actually on it must be independent. And if you think about it, all we give is credibility to the financial statements. So if you have somebody who, say, is auditing IBM and yet they own IBM stock, well, however IBM stock does, the better this, so they have a financial interest in trying to give them a clean audit. So you want to avoid that. Also, any partner in the engagement office. I talked about it before, maybe I didn't. Independence must be in both fact and appearance. Did I talk about that? So, maybe you do own stock in IBM, and maybe you're very diligent and you say, okay, but I don't let that bother me. In fact, I own stock in here. They better have the books correct because I own stock in this place. You might be independent in fact, but the appearance may not be that you're independent. So When we talk about independence, it's independence in fact and appearance. So sometimes, even though someone might be perfectly objective, the appearance might be that they're not. And that we only give credibility to the financial statement, so that's a no-no. Okay. So these are the people in the engagement office that are covered members, and they're going to be held to a higher standard. All the partners and anyone who's working on the audit. Okay, non-attest services. Office. Any partner and manager doing non-attest services. So this could be for like consulting, taxes, things like that. So if they're doing that, if they're non-attest services, they must be independent. Now, notice it only goes down to the manager level though. You could be working on the taxes for IBM. And if you're an associate, you can own stock. You're not a covered member. So these are really the three major kind of categories for the independence. All right, now here you'll notice that there's something, a 10-hour. I think I got this down here, so I'll cover it down here. Okay, it's this one. Non-attest service people are covered members only if they perform 10 hours or more of service during the year. Sometimes they're called 10-hour people. So, for instance, if you do a little bit of work for you know, a client, let's say you do a couple hours worth of work, it's not really that you don't really need to have the independence. The 10-hour rule, and again, this is one of the things that about US standards, they're very rule oriented. That if you do 10 hours or more of services for the client, then you must be independent if you're a partner or a manager. If you're a senior, you could do 1,000 hours of work for them and still be independent. But managers or partners, 10-hour rule, 10-hour people. Okay. Anyone who is in the position to influence the audit. So for instance, a senior partner that might look over all of the audits. They could be if they could influence the audit, or they have input on the audit, they are considered a covered member. The CPA firm itself is a covered member. So the CPA firm must be independent. Get a little bit more into that in a little while here. Okay. Let's put on the next one. Okay, and this last one here, this is sort of a catch-all to any entity that is controlled by covered members, even if not one covered member owns it. Oh, you know, it has control over it, but if there is control amongst the members. Oops. Okay, so. And to get, that's to get around, maybe you have. This partner and this manager each own 30% of an investment that invests in IBM. If that investment, whatever it is 60% owned by covered members, then it's also a covered member. So even though either one of these could say, hey, I don't control it, if the control is with covered members, over 50%, then it's considered a covered member also. It's kind of like a loophole, to get rid of a loophole. Okay, so just to kind of recap, there's a base level for everybody to be independent, which we haven't gotten to yet. But now we have these covered members. These are the people, especially those people that work on the audit, partners in the engagement office, and the non-attest people, partners and managers. Those people are going to be held to a higher standard because they can influence the audit. So that's why we are kind of separating those out, and they're covered by the independence rules. Okay. It's thundering outside. Forget it, man. Okay, direct financial interest. Direct financial interest are not allowed, even if they are immaterial. So no direct financial interest. By direct financial interest, what do we mean? Generally talking about owning stocks or bonds. Oops. So you cannot, if we're looking for if you're doing an audit for IBM, you cannot own IBM stock. You can't own IBM bonds. Both those things will be tied to the audit report, what kind of audit report they get. So direct financial interests are not allowed, even if they are immaterial. You can't own one share of IBM stock if you're auditing IBM. Oops. Indirect. Are allowed, but only if they are immaterial. And let me give you some examples of indirect financial interest. Indirect could be a mutual fund. like a Standard and Poor's 500 fund or something like that. It could be investing in a bank. Bank that loans money to the client. So for example, Bank One, I own stock in Bank One, and Bank One loans money to the client. So these are indirect. Notice that, for instance, the mutual fund. Yeah, we don't directly buy the stock. The mutual fund buys the stock. We buy into the mutual fund. The mutual fund buys the stock. So the mutual fund has a direct interest, but we don't. We buy into the mutual fund. The mutual fund takes that money and invests it in stuff. And bank loans money to the client, so you buy Bank One, and Bank One loans money to the client. Okay, as long as these are, well, these are indirect, but they must also be immaterial. Okay, one of the good ways to go through these and kind of know them is to, I call them cases here. I don't know if they're really cases. Okay, let's go through these. Gina is a member of the audit engagement team for IBM. She owns 5 shares of IBM stock. This is immaterial to Gina. Okay, first thing, is Gina a covered member? You need to answer, put it in the chat. Is Gina a covered member?
Yes.
Yep. Yeah, she's a member of the audit engagement team. So they don't say where she is, I don't think, but she's on the audit engagement team. Okay. So she is a covered member. Is the interest direct or indirect?
It would be indirect.
Actually, it's direct. She owns directly the shares of IBM stock.
Oh, that's right. That's right. Okay. I was looking at the wrong one. Yeah, that's it. Okay.
Yeah, no. And so this, if they directly own any of the stocks and bonds, that's direct. Okay, material or immaterial? It is, well, it says it, right? It's immaterial.
Immaterial.
So, did Gina violate the rules? Is Gina in violation of the rules, I should say?
No.
Direct interest.
Oh, let me see. Direct financial, not allowed. So yes.
Yep, she's in violation of the rules. So 5 shares of stock, it doesn't matter if it's 1 share or a million shares. She is in violation of the rules. She is not independent. Now, if you were Gina, what would be a smart thing to do? Sell the stock. Better to sell 5 shares of stock than to lose your job. So yeah, she could become independent fairly easily. All right, let's go to Greg. Greg is a member of the audit engagement team. Okay, so he is a member of the audit engagement team. He has an investment in a Standard & Poor's 500 mutual fund. Because IBM is in the Standard & Poor's 500, the Standard & Poor's 500 are the 500 biggest companies. Because IBM is in the Standard & Poor's 500, the mutual fund has a direct interest in IBM. So the mutual fund has a direct interest. Greg has an interest in the mutual fund. So for Greg, it's indirect. He buys the mutual fund goes and buys the stock. Okay. So is this direct or indirect?
Indirect, because it's a mutual SP 500 fund.
Yep. He's a member of the audit engagement team, so I should have asked covered member first. But yes,
He's a
this,
covered member, yeah.
and this is indirect. Now, IBM is in the Standard & Poor's 500. It's one of 500 companies. Is this probably going to be material or not material? Or immaterial? So there's 499 other companies in this fund.
Immaterial?
Yeah. Immaterial, you know, it's less than 1%. I mean, it might be, IBM is kind of a big company, but you know, what IBM does probably doesn't make too much of a difference in the Standard & Poor's 500 because there's 499 other companies in it. Okay, so covered member, indirect, immaterial. Is Greg in violation of the independence rules?
No.
No,
No, he is not. You know, I should make these a different color. Make these green. Stand out a little more. Okay, so Greg, Standard & Poor's 500 fund, probably not. Okay. Helen is not a member of the audit engagement team. However, she is a senior auditor in the engagement office. She owns 500 shares of IBM stock. This investment is material to Helen. Okay, so let's see. She's a senior auditor. So let's grab that one and go up here. So she's not on the engagement team. But she is a senior auditor. Is she a covered member?
no,
No. If you're a senior and you're not on the audit engagement team, you are not a covered member. So maybe this is her. I don't know. It looks like her. So we'll say that one's her. Yeah, not a covered member because she is not on the engagement team. She's a senior, but not on the engagement team. So she is not a covered member. Now, if she's not a covered member, does she have to follow the covered member rules?
no,
Okay, so interest, is it direct or indirect? She owns shares of stock.
oh, stocks are direct.
Yep, it's a direct interest. And it's material to her. So in the survey, they say, oh, this is really bad. However, she's not a covered member. If you're not a covered member, is she in violation of the independence rules? No,
No,
not a covered member. You have to be a covered member to be covered by those rules. If you're not a covered member, there are some rules for them, but we'll talk about those later. You generally have to be very, very wealthy to be a violation. So anyway, yeah, so not a covered member. Okay, well, if you're not a covered member, yeah, so this would be no. Let's make that green. So she is not in violation. She can keep the stock. That's it. Okay. Well, one thing, kind of a loophole would be, so say, okay, oh, I can't own the stock. I know, I'll give the stock to my daughter. Then I'm not, then there's no problem. Well, immediate family is considered to be the same as the covered member. So it's part of the covered member is their immediate family. Just to kind of round that out. Okay, so who is immediate family? It's spouse. Spousal equivalents. Spelled that wrong? Yes, I did. And dependent children. So these are, I mean, it basically, when you go home, who do you see? Those are immediate family members. So spousal equivalents, and dependent children, and the dependent there is important. So, someone who is living at home and got a child. And so immediate family members. Say this. They're covered members relating to the covered member. That's there's probably a better way to say that. Let's leave it. They're considered covered members. So if Jill has the spouse with a dementia, those are all considered to be covered members when it comes to her independence. Okay. So, immediate family members. Cases, Sharon is a member of the audit engagement team. Okay. She does not own any shares of IBM stock, but her husband owns 10,000 shares of IBM stock. Okay, husband, covered member or not a covered member?
Covered member.
Remember. Direct or indirect?
Direct.
Direct. Now, when it comes to the shares, it's hard to know, they may be very wealthy people, maybe 10,000 shares of IBM. That'd probably be worth like a couple $1 million up today, but really though, it doesn't really matter. I'm gonna say it's probably material, it's a lot of stock. But it really doesn't matter, because can a covered member have direct interest?
No.
Oh, so is she in violation? Yes, she is.
Yes.
And again, even if it was immaterial, it doesn't matter. Now, if this was an indirect interest that was immaterial, then we have something different. But direct interest, the covered member cannot own any of it. And her husband is the spouse or spousal equivalent. Okay. Steve is a member of the audit engagement team. He does not own any shares of stock, but his dependent daughter owns an immaterial amount of IBM stock. Okay, he's part of the audit engagement team, so he is a
Covered member.
member. His daughter owns the stock. It's immaterial amount of IBM stock. This gets a little bit tricky. Is this direct or indirect? Stock is what?
Direct.
Yep. So don't think, okay, well, it's indirect because his daughter owns it. No, his daughter is considered the same as he is. This is as if he owns the stock. So it's a direct interest, and they'll tell us right off it's immaterial, but that doesn't really matter. Is Steve in violation?
Yes.
Yep. Even a small amount of stock owned by a dependent daughter. Okay. Let's go to Jolene. Jolene is a member of the audit engagement team. She does not own any shares of IBM stock, but her husband has a large investment in a technology fund. Okay, so this is a technology fund. 40% of the technology fund holding are in IBM stock. Okay, so let's get to her husband. Covered member or not a covered member?
Covered.
Covered, good. This is he has an investment in a technology fund. Direct or indirect?
Indirect. Sorry.
Now, here's the thing though, this is unlike the other one, the Standard Poor's 500. This is 40% is in IBM stock, and this is a large investment.
Material.
Yeah, it's probably material. Good question. What makes something immaterial or material? I'm a little confused. Okay, yeah, let me answer this one, then I'll get back to what is that. Oops. I do here. It's something wrong. Okay, so this is private. So this again is a covered member. Indirect interest, which is allowed as long as it's immaterial. This is probably material. It's a large investment, and 40% of it is in. So are they in violation? Yes.
So, Professor, if they are in violation, do they have to pay a fine, or do they just have to make their wrong right?
Well, the easiest thing to do, and by the way, when you join a CPA firm, the easiest thing that they'll give you a list and they'll say, here's all our clients. Do you own any stock in any of these clients? And if you say yes, they say, oh, well, go ahead and sell it. Because they don't want you, they don't want anyone actually. So even though like that office one that the senior who wasn't a covered member, yeah, she would be considered a a lot of times in the office they will just say, look, if you own any of the stock, you can get rid of it as part of it.
Okay.
But technically, if she owned the stock. Now, as far as independent, if they can, again, selling the stock especially for direct interest or even indirect interest, this material is the way to go. But what is material? Excellent question. The material is based on if it's material to the individual. So notice, and we're in a case like this later when I show you, selling this material to one person may not be material to another. And so the investment, for instance, the one we just covered where the husband had a large investment. If the investment was small or immaterial to the husband, even if it was the dollar amount was kind of big, if it was a small investment to the husband, maybe they're multi-millionaires, then it would be considered immaterial. So it isn't necessarily a dollar amount. It's the dollar amount as it relates to, the income or the financial position of the individual. Is it vague? Yeah, it is vague. I mean, the only thing it's not vague is you can't have direct financial interest, period. That's not vague. But as far as whether it's material or not, that can be a little bit of a vague area. And so, yeah, and materiality is really hard. I mean, because in two, even though two people who make the same amount of money are in the same financial position, one might consider it to be material where the other one maybe doesn't, even though it's the same amount. So it's a judgment call. Materiality is a judgment call, and it's like that in audits also. What's material to the IBM audit? Is it 10 million, 15 million? What is it? Those are all judgment calls, which is why auditing is difficult. It's difficult to learn, difficult to figure out. So yeah, it's material to the individual. Okay. Close relatives and friends are also in here. here still, so I'll, hopefully this will last. Okay, so close relatives are parents. Siblings, brothers and sisters. Non-dependent children. Okay, and these are. They can have, they're allowed indirect and indirect financial interest as long as they are immaterial. Or unknown, which I'll get to. Let me see here. They're immaterial. Here's the wacky one. So this is one, say. A lot of indirect. Direct or indirect finances, if they are material. Oops. Okay. So they're allowed, okay, they're allowed direct or indirect financial interest if they are material. So they can have material ones as long as they are unknown to the covered member. And here's the thing, you know, you may have a brother or sister or something that you haven't talked to in 20 years. Or maybe your parents haven't talked to in 20 years or whatever. Or children, you know, so. It'd be impossible to know if they have a material interest or not. Now, if you know about it, it's a violation. If it's unknown. And it has to be unknown, then it's not a violation. If you think about it, if it's unknown, there would be nothing to influence you. You know, yeah, my brother, who I haven't spoken to in 30 years, he has a financial interest in IBM. But if I don't know that, you couldn't possibly have anything to do with it. So this is a weird one. Now, you say, well, could they just say it's unknown? Yeah, well, there's ethics parts of this too, you know, if you do know about it, you know, it must be, disclosed. Yeah, but it does bring up another thing I'll talk about in a minute here. Okay. Wanda is a member of the audit engagement team. Okay, so Wanda's a covered member. She does not own any shares of IBM stock, but knows that her sister owns 500 shares. Okay, so her sister owns 500 shares. Is that direct or indirect?
Direct.
Direct. The investment is immaterial to her sister. Okay, tell us it's immaterial. Is Wanda in violation?
Yes.
Actually, no. Why? Because it's in.
Oh, because it's immaterial. That was tricky.
It is tricky, but we'll see why it's especially tricky with the next one.
Okay.
Making those green. We keep saving this just in case lose the power again. Okay, Stacy is a member of the audit engagement team. Okay, so Stacy's a covered member. And like I said, but knows that her brother owns 300 shares of IBM stock. Okay, so again, we got a direct interest. The IBM stock is material to her brother. Is Stacy in violation?
Yes.
Yep. So notice it isn't, a certain number. Do it here, hold on. Yeah, I gotta pay attention here for just a moment. We're talking. Nope. Again. There we go. See, you guys thought I wouldn't be able to do that. All right, so she's in violation. Now notice, this is one is for 300 shares, 500 shares, but the 500 shares is immaterial to Wanda's sister, whereas the 300 shares is material to Stacy's brother. Okay. Lawrence. Member of the audit engagement team. So Lawrence is a covered member. He does not own any shares of IBM stock, but his father has a material investment in IBM stock. It's a direct interest, owns IBM stock, and it's material. Sorry about that. I keep thinking I'm going to sneeze here. Try to mute it. All right. Now, this is very important though. Lawrence does not know about the IBM investment. Lawrence may not have talked to his father for 20 years, or maybe they talk all the time, but they never talk about investments. Is Lawrence in violation of the independence rules?
No.
No. It's this wacky rule here. They're allowed to have material interest if it's unknown to the member, so he doesn't know anything about it. Okay, so May is a member of the audit engagement team. She does not own any shares of IBM stock, but her mother owns the stock. May knows about the investment. Asks her mother to sell it. Her mother refuses to sell it. Okay, May, covered member? Yep. For the audit engagement team. Interest, direct or indirect?
Direct.
Yep. And material. Yeah, material. Right. And is May in violation of the rules?
Unfortunately, yes.
Yeah.
Yeah, I know that. Thanks, Mom. I'm gonna move back. You think about that? Yeah, no, and I know that there have been lawsuits about this. That people say, well, look, it's none of my doing, but I'm being prevented from making a living. Basically, you have the right to make a living, and when you run into something like this, it's like I have no control over it. So I know that there have been cases of this where someone has been excluded because of the non-independence, when they say there's nothing I can do about it. It's not under my control. And it's forcing me not to make it. Okay, let's stop here. While we still have electricity. Well, you know what? It actually has calmed down here now in the last few minutes. I don't know if it's gonna start up again, but I tell you what, I'll go ahead and do the work on the I'm drawing a blank here, classical sampling. So let's go ahead and stop here. Save this quickly. And let's go ahead, we can go ahead and do work on the classical sampling. Now, if you already turned in the classical sampling or you already have it done, you don't need to watch this, that's fine. And there's no guarantee it's gonna stay on anyway. So but anyway, if you want to stick around, if you need to do the classical sampling, stick around and I will kind of go through it. And yeah, hopefully we will keep electricity. It actually, it sounds like it just stopped like outside, so I'm hoping that is the case. Okay. Okay, so did we already do check? We do problem 3? Looks like we did. Did we already do all this?
Yeah, we did.
Yeah, we went through that all, and then we had the one for number 5 for homework,
Okay,
and that was it.
okay. I'll tell you what, let me I'll go through the homework. I'll go through the chapter 5 just to kind of round this out. And then did I already I think I already went through the last things in that. Yeah, okay. All right, so chapter 5 for the homework. So if you haven't done the homework, or if you want to check and see if your answer is correct, stick around here. Okay, let's see. So the total number of accounts. 100,000, we got a sample size of 1,000. One of the things about sample size is when you start getting into the larger numbers like 1,000, it wouldn't matter if this was 100,000 or 100 million, you know, at some point, a sample size, if it gets large enough, you're at the 99% level, pretty much. And you know, think about it, it's only 1%, but you can get so accurate with this, that 1%. Okay, so 64,000 divided by 1,000. 64. And I believe this is an actual CPA exam problem. You know, they used to, you know, be able to, there was an open exam, you would. I think I told you guys this, I don't know if I did or not. But they used to take the exam, they'd have the exam and then they'd have an answer sheet. And at the end of the day, you'd turn in the answer sheet. And if you wanted the exam, you gave them a self-addressed stamped envelope. And they would put the exam in, they would actually mail you the exam that you took. So that all of it was open. Now, there's also another quirk about it, and that was the quirk was that you couldn't use calculators. For years, they had no calculators for the CPA exam. Which means that a lot of times you had questions like this that was nice, they were nice and easy to come up with the math, so to speak. So okay, so 64 is the average, and the book average is 61. Okay, I'm going to copy these down. All right. So Mean per unit. The audit number is the best number, so to speak. The terminology that they use is most persuasive. Oops. Caps lock there, maybe. So we're going to use our audit number. So the mean we're talking about is our audit number. So the audit number is 64. Okay, and we're going to multiply it and say, okay, everything it should be worth are 64. So if you have 100,000 of these, you take 100,000 of those times they're 64. And this will be our projected value. So 6.4 million. Oops, fade away with the zeros there. Okay, so this will be our projected value. Okay, so let's see, I can't remember how I did it up here. I'm going to copy this. Let me teach you guys how to copy and paste. Won't that be great? So one thing I want you guys to learn is how to be lazy, just like me. All right, so $6 million. And the projected is 4 million. So projected misstatement is what, 400,000? All right, so we're saying it should be 6,400,000. They say it's 6 million. Is this an overstatement or an understatement?
Over.
Okay, so 400,000. So it's an understatement, isn't it? Let's see, so we're saying it should be 6,400,000. They only have 600,000 on the book, so this is actually going to be a understatement, right? Because remember, we're for us, it's you know, this is the amount that we think is correct. This is the amount that they have, so it's going to be understated. This is spacing with funny on this. Okay. And mean per unit's good when all this stuff has about the same value. You know, so if everything is around, you know, in the 60s or something like that, it would be an okay one to use. And it also one, and this is, it has to be a very rare situation where you don't know necessarily what the average book value is. Maybe there's something that's causing you not to be able to get a nice clean number for the book value, because this one, you'll notice it doesn't use the book value. It just uses the audit value. Okay, ratio estimation. And ratio estimation, I think, is probably theoretically maybe the best one. And that is, you take the audit average, which is 64. And you're going to divide it by the book average. Which was 60, nope, 61. Hey, that's not a dollar sign. That's not a dollar sign either. And I can't blame that on the power outage. Wow, the power outage. What's I got there? All right. Ratio estimation says that everything is off by a ratio. In other words, large things are off by large amounts, small things are off by small amounts. And so you take this ratio and you multiply it by the book value. Go up here and do this. So total book value is 6 million.
It will be 6295082.
Six two nine five 082. And this will be our projected value. So we're saying everything is off by the same ratio. Big things are off by big dollars, small things are off by small dollars. And that this is our predicted value. Copy this down here. Okay, so was this 395,082? No, 295.
295082.
So 295,082 would be the mistake. Okay, so worst. I should copy this. So we're saying that they should be at 6,295,000. So this. So the misstatement of 295,082, is this an overstatement or understatement? So this is the correct amount. We think that it should be 6 million.
Under.
Yeah, this is an understatement. We think it should be $295,000 more. So their 6 million is understated by 295,000. Difference estimation is kind of a wacky one for a number of reasons. First of all, we're going to get the projected misstatement first, but it's also kind of wacky in the way it's oops. Laid out in that it assumes that everything's off by the same amount. So if it's a $50 account, it's off by the same as a $50,000 account. I'm not sure how many populations fit into that, but if they do, this is one to use. So the difference is what, $3? So what we're telling them is, look, everything in all of your all of your 100,000 items are off by $3. So we're gonna multiply this. Now the total accounts were 100,000, so we say every one of these accounts is off by $3. So 3 times 100,000 is 300,000, right? Now, be careful on this one because this is the projected misstatement. Damn. I gotta do something here. Oh, that was wrong. Okay, so our projected misstatement is 300,000, so this is. I think it's wacky, you can get our misstatement first out of this one. So not only kind of wacky because it assumes everything's up by the same amount. But it is, now. This $3. So we're saying that it should be, these all should be 64. They're saying it's 61, so we're saying it's 3 now. Is this an understatement or an overstatement? We say it should be 64, and this is one that we are, is our best estimate. Most persuasive. So there's 61, is that overstated or understated?
Understated.
Yep, good. Yeah, so this is understated. And it's understated because we're saying that they have to add $3 to each one of these. Okay, now, so this is where this kind of comes in down.
Projected value will be 5,700,000.
You could go the other way. So the question is, what must the projected value be if this is understated? That means this is going to have to be higher or lower?
Lower.
I'm sorry, I said that wrong. If the projected value is going to have to be higher or lower than 6 million. We're saying that this is understated.
Could it be higher?
Yeah, so it's gonna have to be higher than 6 million, so this is gonna be what, 6,300,000, right? Because this is an understatement. Actually, both these are. So this is going to be our I'm thinking. Okay. And so this one, again, this is a weird one because you kind of have to back into it, and it's hard to keep track of whether it's going up or down. So this is understated. So they're going to have more on their books to bring it up to the correct level. Were all these understated? Yeah, okay, they're all understated. It doesn't always work out that way. Hey, we still got electricity. Okay, any questions? Okay, we should have those done now. If you missed last time, I'll flash up the ones we had from before up here. Go back to where did we stop the first time? We stop here. We stopped here. Okay, so this is number 3. Oops. And you want to just take a screenshot of that. If you need, the answer is number 3. Take a screenshot of that. And here's the difference estimation for number 3. This is 4. Or should look like that. And this is E for number 4. Hey, look, it's the same $3. Oh, it's $3 going in the opposite direction. This one we just did. And then at the end here is kind of when do we use which one? Back out a little bit here. So this is number 6. Mean per unit is best when the populations have similar values. They're all around the same size. Mean per unit is a good one to use. Ratio estimation is good to use. For probably most situations, it means that there's a ratio of what things are off by. In other words, large things have large errors, small things have small errors. You know, a $50 account will have a smaller error than a $50,000 account. And the one that really not used as much, but it is definitely is a possibility that could be used depending on your population. Tips for different estimation is when all items like to be off by stated by the same amount. So it's kind of like I don't want to say the opposite of ratio, but ratio says big things off by big amounts, small things off by small amounts. Difference estimation says everything's off by the same. A $50 account's gonna be off by the same dollars as a $50,000 account. Any question on that? Okay. Well,